Nathan Sheets joining us right now in studio to talk a little bit about his assessment of that as well. Global Chief Economist over at Citi. Nathan, great to have you here on set. And when you hear Powell talk about economic conditions and how supportive, at least in his words, they are right now of Fed policy and I guess the cushion that they have to maybe just sit by and see what happens next.
Yeah, I think the reality here is over the last few months in particular, we have seen a very significant upward move in longer-term interest rates. And when the Fed runs its models, when the Fed thinks about financial conditions, that longer end of the curve really weighs heavily in economic outcomes. And I think that has probably given the Fed a notch more confidence that the treatment that it is prescribed is getting the traction and will ultimately get the traction that they desire. And in the press conference today, Jay Powell had numerous opportunities to lean into a 25 basis point hike in December, and he did not take them. Yeah. And I think the conclusion now that kind of the maintained path of policy in the Fed's head, notwithstanding the previous dot plot, is that they've done enough, and now we're in the world of higher for longer.
So I guess the focus now really turns to the dot plot, and I learned something new here, which is that they lose efficacy the longer the time goes. So they really matter when they're first released, but after the next set of data points, they matter less. If the dot plots show any adjustment, people are going to look ahead right away to the pivot.
Yeah, very important point. At the December meeting, we will have new projections. We'll have a new dot plot. And at that point, the Fed's going to have to explicitly address, are we hiking at this meeting? Now, I guess another strategy is to say, well, there's another one out there someplace. And to allude that maybe in the first half of the year, they'll need to do more. But then what about the cuts that they had in the back end of the curve? So this next dot plot, I would expect it, if it goes as they think it will, that they're going to be holding in December, and then maybe that translates into perhaps one less cut in 2024.
Well, in this conversation about whether they're going to hike again, when we might start to see those cuts, it was interesting to hear Jerome Powell say that the Fed is really still trying to gain confidence in what the appropriate stance of policy is. And when you think about the different risks out there, the risk of doing too much versus doing too little, where do you think the bigger one is right now?
So Powell is struggling with this double reality. On the one hand, has he seen progress? Absolutely. Core PCE 18 months, 2 years ago, was running at 5.5% or higher. Now it's running at 3.7%. And my expectation is in coming months, it's likely to fall somewhat further. But at the same token, inflation is not back at that 2% level that they desire. And the economy, the labor market continue to seem to be pretty strong. So what he's struggling with here is we see some improvement, we see some momentum in the disinflation process. Yeah. We know we're tighter, but have we done enough? And I think he's essentially said, well, let's wait and see.
The flip side of though is that whether they've done too much, and he did address the stress in the housing sector from 8% mortgage rates. He also talked about some of the stress that you're seeing in business investment and refinancing, and that raises a lot of questions about the pace of GDP growth, at least that we saw in the most recent quarter, in the third quarter, whether that's an anomaly and we should expect some sort of leveling out.
My sense is, especially coming off that very strong third quarter, and given the momentum that I continue to see in the labor market in particular, that they are at a place where Powell's willing to live with the risk at this stage, given where they are, that they've hiked too much. And if it does seem like some of those pressure points start to manifest themselves, then he's got plenty of room to ease policy. And I do think that he's ready in the fullness of time. If the economy slows more rapidly than he's expecting, I think Powell is more than prepared to say, okay, we've done enough, maybe we've done more than enough, and we'll start cutting rates.
How committed do you think the Fed is to that 2% inflation target? Is it enough to trigger a recession, or will 3% or 2-ish% be good enough to signal the all clear if recession is the unavoidable alternative?
This is a huge question that I personally struggle with. My sense is that Jay Powell, especially now that we're looking at three-handle inflation rates, that he doesn't want to trigger a recession necessarily to get inflation back down to 2%, as long as the markets are viewing Fed policy as credible. And I think the measure of their credibility, the North Star for Fed policy through this episode, are inflation expectations, and particularly the longer-term inflation expectations. Yeah. And the sad reality here is, we have seen a little bit of nudging up in those. And that is that the market's voting every day on how credible the Fed is.
Great analysis as always, Nathan. Great to catch up with you. Nathan Sheets, of course, the chief economist over at Citi, helping us parse some of what we heard from Jay Powell.